It is Christmas Eve, a day when markets are supposed to be silent. Yet beneath the surface, the global silver market is experiencing unprecedented stress and historic instability. While families wrap gifts and financial centers appear calm, invisible forces are tearing apart long-standing assumptions about price discovery, liquidity, and trust in modern commodity markets. The East and West are no longer moving in sync, as physical silver demand in Asia diverges violently from paper pricing mechanisms dominating Western exchanges. For decades, arbitrage kept global silver prices aligned, ensuring minor differences quickly vanish through trade, logistics, and institutional balance sheets. Today, that invisible stabilizing mechanism has failed, exposing a fragile system built on promises rather than readily available physical metal. In Asian markets, buyers are aggressively bidding for immediate delivery, signaling urgency, scarcity, and a fundamental shift in how silver is valued. Meanwhile, Western exchanges continue quoting prices that increasingly resemble theoretical numbers rather than actionable prices for real, deliverable silver. This widening gap is not speculation or volatility, but a structural breakdown where physical reality is overwhelming financial abstraction. Silver, long treated as a secondary monetary metal, is suddenly revealing its strategic importance to modern industrial and geopolitical systems. Solar energy, electronics, and advanced manufacturing rely on silver inputs that cannot be easily substituted or delayed without severe consequences. As supply chains tighten, industrial buyers are prioritizing certainty of delivery over price, reshaping demand dynamics in real time. The result is an accelerating feedback loop where scarcity fuels urgency, urgency fuels price divergence, and divergence drains physical inventories. Western vaults, once considered deep reservoirs of metal, are being steadily depleted as silver migrates toward markets offering higher real value. Each ounce leaving the system weakens confidence in paper contracts that assume metal can always be sourced on demand. This erosion of trust strikes at the core of modern financial infrastructure, where liquidity depends on belief rather than possession. Risk managers understand that once confidence breaks, markets do not gradually adjust. They reprice violently and without warning. What we are witnessing is not a temporary imbalance, but the early stage of a profound regime change in the silver market. Power overpricing is shifting from financial centers to physical hubs where metal changes hands and scarcity is undeniable. History shows that when commodities decouple from paper control, prices move not in steps, but in sudden, exponential surges. This moment marks the beginning of a new chapter, where silver's true value is rediscovered through necessity, not negotiation. The most alarming signal in this unfolding crisis is the persistent price gap between major exchanges, a gap so large it defies decades of market behavior. In normal conditions, such differences would vanish within minutes as traders exploit arbitrage opportunities and restore balance across regions. Instead, the spread is widening, proving that metal cannot move freely despite enormous financial incentives to do so. This failure reveals a deeper truth that silver quoted on screens is not the same as silver that can be delivered. Paper markets assume abundance, while physical markets are confronting hard limits imposed by mining output and logistical constraints. As inventories shrink, the illusion of infinite supply collapses under the weight of real-world demand. Industrial buyers are not speculators chasing momentum. They are securing essential inputs to keep factories running. For them, price is secondary to availability, and delays translate directly into lost revenue and broken contracts. This creates a form of demand that does not retreat during volatility, but intensifies as uncertainty grows. Western exchanges are discovering that confidence alone cannot substitute for metal that does not exist in sufficient quantity. Each failed arbitrage attempt signals that logistics, vault access, or inventory ownership is blocking normal market function. Banks accustomed to sourcing silver through swaps and leases are encountering refusals and closed doors. Trust between institutions is eroding as each player prioritizes survival over cooperation. When lending freezes, liquidity vanishes, and prices lose their anchor to traditional benchmarks. This environment favors markets that demand physical settlement rather than cash equivalents or deferred promises. Asian exchanges, built around delivery and possession, are increasingly dictating terms to the global system. The longer this imbalance persists, the faster remaining inventories are drained from Western vaults. What looks like a price anomaly is actually a physical migration of silver from one hemisphere to another. Such migrations historically precede sharp repricing events that catch unprepared institutions off guard. The silver market is now signaling that equilibrium will only return at dramatically higher price levels. Governments are now quietly monitoring silver flows because this metal underpins energy transition plans, defense technologies, and critical infrastructure across multiple strategic industries. Unlike gold, silver is consumed, dispersed, and rarely recycled efficiently, making shortages far more dangerous over extended time horizons. Each year, industrial usage removes silver permanently from circulation, tightening supply regardless of futures market pricing. Mining companies cannot rapidly respond because new silver production requires years of permitting, capital investment, and geological uncertainty. Even aggressive expansion plans fail to offset declining ore grades and rising extraction costs across major producing regions. This structural supply ceiling transforms silver scarcity from a cyclical issue into a long-term constraint. As governments prioritize strategic stockpiles, private buyers are increasingly pushed to the back of the allocation line. Strategic demand is price insensitive, meaning higher prices do not reduce consumption when national security is involved. This creates a hidden layer of demand that never appears transparently on public exchanges. Official silence masks a growing competition among nations to secure long-term access to physical silver supplies. History shows that when states compete for resources, markets lose their ability to self-correct peacefully. Export restrictions, preferential contracts, and quiet hoarding gradually replace open market transactions. These actions fragment global pricing and accelerate the breakdown of unified benchmark prices. Western financial models still assume silver behaves like a liquid, endlessly tradable commodity. Reality is revealing silver to be a strategic material governed by politics as much as economics. As policy decisions override price signals, market transparency deteriorates further. Investors relying solely on charts and ratios are missing the deeper geopolitical forces reshaping supply. The silver market is transitioning from a financial playground into a strategic battleground. Once this transition completes, price discovery will occur through scarcity events rather than orderly auctions. By the time official data confirms the shift, repricing will already be irreversible. As physical silver tightens, derivative markets are becoming increasingly unstable, amplifying small shocks into outsized price reactions. Futures contracts assume orderly rollovers and smooth settlement, yet both rely on confidence that physical supply exists somewhere in the system. When that confidence weakens, leverage magnifies risk instead of distributing it. Traders accustomed to cash settlement are discovering that counterparties now demand metal, not margin adjustments. This shift transforms routine hedging into a high-stakes contest for limited inventory. Volatility spikes are no longer random. They cluster around delivery windows and inventory reporting dates. Each reporting cycle exposes thinner buffers and rising stress within clearing mechanisms. Market makers are widening spreads, quietly signaling that liquidity is becoming conditional. Conditional liquidity means prices move abruptly when thresholds are crossed. Algorithms calibrated for stable correlations are misfiring in this new environment. Automated strategies exacerbate moves as they react to signals divorced from physical reality. Human discretion is returning as machines fail to interpret scarcity. This reversal marks the end of an era dominated by frictionless electronic trading. Physical constraints are reasserting themselves over abstract financial engineering. Exchanges face a dilemma between preserving credibility and revealing uncomfortable truths. Transparency risks panic, yet opacity accelerates mistrust. Regulators are watching closely, aware that intervention may come too late to restore confidence. Once settlement disputes emerge, reputational damage spreads faster than price volatility. The silver market's fragility is becoming impossible to conceal. What follows is a phase where price discovery becomes episodic, violent, and irreversible. For investors, this environment demands a complete rethinking of risk, because historical correlations no longer provide reliable guidance. Silver is no longer behaving like a simple inflation hedge or a leveraged proxy for gold. Instead, it is reacting to physical stress, geopolitical pressure, and industrial necessity simultaneously. Traditional portfolio models struggle when one asset plays monetary, industrial, and strategic roles at the same time. Volatility is no longer a sign of speculation, but evidence of constrained supply colliding with inflexible demand. Short-term price drops do not indicate weakness. They reflect temporary liquidity events within a tightening system. Long-term holders are increasingly removing metal from circulation, reducing float and amplifying future moves. This behavior mirrors historical episodes where commodities transitioned from surplus to scarcity regimes. During such transitions, price discovery becomes discontinuous rather than smooth. Investors waiting for confirmation often discover that confirmation arrives only after prices have repriced dramatically. Risk is shifting from owning silver to not having access when it is needed. Paper exposure may offer convenience, but it does not guarantee protection during delivery stress. The distinction between ownership and entitlement is becoming critical. In past crises, assets tied to physical control outperformed those tied to contractual promises. Silver is now approaching that threshold where possession outweighs price precision. Market participants ignoring this shift risk being trapped by instruments that fail to settle as expected. This is not a prediction, but a pattern repeatedly observed across commodity history. The difference this time lies in silver's central role in modern technological systems. As demand accelerates, the window for strategic positioning narrows rapidly. When recognition becomes universal, scarcity will already be fully priced in. On a societal level, silver shortages ripple outward, affecting energy affordability, technological progress, and the stability of future infrastructure investments. Renewable energy targets assume uninterrupted access to silver-intensive components that are now facing procurement uncertainty. Delays in material supply quietly translate into higher project costs and slower deployment timelines. These pressures accumulate invisibly until public policy goals collide with physical resource limits. Governments respond first with subsidies, then with mandates, and finally with direct intervention in supply chains. Each intervention distorts pricing signals further, masking scarcity rather than resolving it. Over time, consumers absorb the cost through higher electricity prices and reduced technological choice. Inflation statistics struggle to capture these hidden cost transfers embedded in complex products. What appears as stable pricing is often the result of deferred investment and quality compromise. Silver scarcity thus becomes a silent contributor to long-term economic stagnation. Infrastructure planners are forced to redesign systems around material availability instead of optimal efficiency. This redesign introduces fragility into systems originally built for abundance. As redundancy disappears, resilience declines across energy grids and communication networks. The consequences emerge slowly, then suddenly, when systems face unexpected stress. Historical precedents show that resource constraints often surface first as technical failures. Only later are they recognized as economic or strategic miscalculations. Silver's role ensures these failures occur at critical technological junctions. Societies that ignore material realities pay higher costs to restore stability later. Awareness arrives not through reports, but through lived disruptions. By then, adjustment options are fewer and far more expensive. Strategic stockpiling becomes the final lever when markets fail to allocate scarce silver efficiently. Nations quietly compete to secure long-term supply agreements beyond public commodity exchanges. This competition reshapes trade relationships and redraws geopolitical alliances. Smaller economies struggle to access material once reserved through bilateral deals. Market transparency declines as pricing shifts into private contracts. Official benchmarks lose relevance when physical delivery dictates value. Investors relying on paper signals find themselves reacting too late. The distinction between price and value becomes unmistakably clear. Physical control replaces financial abstraction as the source of leverage. Institutions built on liquidity assumptions confront structural limits. Trust erodes fastest where delivery promises cannot be honored. Legal disputes increase as contracts collide with unavailable supply. Courts struggle to arbitrate value when markets no longer agree. Risk premiums rise across industries dependent on silver inputs. Capital reallocates toward resource security rather than innovation. Productivity gains slow as defensive strategies dominate planning. Economic momentum weakens under the weight of precautionary behavior. Scarcity reshapes priorities from growth toward preservation. Systems designed for efficiency pivot reluctantly toward resilience. This transition defines the next phase of the global economic cycle. In the final stage of this cycle, silver's price no longer reflects negotiation, but necessity enforced by limited availability. Markets adapt not through smooth adjustment, but through abrupt recognition of irreversible constraints. Those who prepared early are positioned not for speculation, but for continuity amid disruption. Those who ignored physical signals are forced into reactive decisions under unfavorable conditions. The silver market thus becomes a case study in how modern systems fail when abstraction exceeds reality. Financial sophistication proves useless when underlying resources cannot be summoned on demand. This lesson extends beyond silver, warning of similar stress across other critical materials. Complexity magnifies fragility when supply chains depend on assumptions rather than reserves. The era of effortless globalization gives way to a world defined by material limits. Strategic foresight replaces short-term optimization as the dominant economic discipline. Policy, capital, and industry realign around security of supply. Growth narratives are rewritten to account for constraint rather than abundance. Resilience becomes the primary metric of success. Systems designed with redundancy regain long-term viability. Silver's journey reveals how scarcity reshapes value itself. Value becomes anchored in control, access, and reliability. Price volatility fades only after ownership structures stabilize. When stability returns, it does so at permanently higher valuation levels. The transition feels chaotic, but it follows a familiar historical rhythm. Silver ultimately reminds markets that reality always reasserts itself.